morning, everyone. It's Tuesday morning at 10 a.m. Good to see everybody. I missed you all last week. Sorry I didn't see you. I started to not feel well Sunday night, and it progressively got worse pretty quickly throughout the week. So I ended up laid up all week, but all good now, and happy to see everybody. So we're gonna, I appreciate everyone who responded to the survey questionnaires, and in response to that, I'm going to have a little bit of some changes this week. So we'll see how it goes, but let's move on. So welcome everybody. Remember that you are muted, and that this webinar is being recorded. It'll be shared on our website shortly, within the next few days. And what we're going to do is we're going to go over some Slott updates, and that's one of the things I'm going to do is I'm going to share my screen with you during those updates so that you can follow along. Some of the feedback I received is that there's a lot of information there, and sometimes it's hard to follow along. So I'm going to share my screen and just share my notes. I tried to lay it in a PowerPoint, but the information, there's just so much information, it would just take slide after slide after slide. So what you're going to see is my notes with the Slott updates. So you should be able to follow along with that. But if for some reason that doesn't work, let me know. You know, we want to make sure that we're doing everything we can to make this the best experience for you. We're going to talk about the markets a bit, and then we're going to get into our financial planning topic. Our financial planning topic is the Secure 2.0 law that was recently passed in the House of Representatives by a wide margin, and will likely become law soon. And there are some good things about it, but more confusion regarding RMDs, and I think it'll just make things more complex, and frankly doesn't act fast enough in my opinion, but that's okay. So we'll cover that information as well. We have our next event coming up is David McKnight Live here in Newtown. So that is, let's see, 3 weeks from tomorrow. So the April 27th for you folks, starting at 5, you should be receiving an email invitation either tonight or tomorrow. For that, you've got your own portal where you're going to be able to RSVP, and yes, of course, you'll be there for the VIP event, and can stay for the program, of course, if you'd like. That's the idea. But you have the opportunity to come an hour before, just for a special meet and greet with David. So that should be fun. Okay, let's see. We've just made some updates. We've been working on this for some time, but I just finalized some changes to our investment models yesterday. So we'll be making those changes within the next few weeks, and I plan on releasing a video with some detailed information on that. You know, this really has to do with protecting some of this volatility that we've been seeing for sure, and are likely going to be seeing for the next year or several years, as we kind of unwind out of the craziness that has been COVID. And the shock waves all around that, this very hyperinflation situation that we're seeing ourselves in, war, you know, around the world, and all the uncertainty that brings. We'll likely see a recession within the next year or two, in my opinion. We're going to talk about that a little bit today as well, but we're just trying to stave off or get ahead of some of these things for you folks. So we've updated our portfolios in a pretty dramatic way. We've kept some of our core components, but we've added in some things that we believe are going to be very, very helpful. All right, so let's just do a check here. Just raise your hand if you can see me and hear me okay. So that is, there's a raise your hand button on the bottom, and that'll raise your hand. So I was talking to somebody, and she said, when you said that, I thought people were just going like this, and you could see us, but I can't see you. So I think that's cute. But you could, there's on the bottom of your screen, there's a bunch of icons, and one of them should be Q&A. So there is Q&A. If you have questions, of course, type that in. And the other one should be raise your hand, and most of you understand that and you're good at it, but I appreciate that feedback as always. All right, so I am going to share my screen. I'm going to try to keep this kind of a slow scroll so you can read along with me, but let me share that. And you are going to see my notes. So if I forget and you see just my notes, they're just my notes. They're not, there's no client info in there. There's nothing, exciting or crazy. It's just my notes that I use to prepare for these things. So you should see a copy of my notes, and it's under the category Ed Slott updates. And just raise your hand if you can see that. Thank you, everyone. All right, so you'll see that this was just posted yesterday, the 4th of April, and this is from Andy Ives, and one of the analysts in the Ed Slott group. You all have met Ian Berger, and or maybe it was Andy who was with us. Goodness, I don't remember. Sarah just a few weeks ago joined us, but we've had let's see who we had. Let me go to my website and see who that was. I'm embarrassed that I can't remember if it was Andy or Ian who joined us a few weeks ago, or months ago now. Andy, it was Andy. Yes, it was Andy. So Andy came on and he talked about net unrealized appreciation, and that's one of his specialties. But here he's talking about missed 2021 RMDs within the 10-year rule. So you'll remember that there has been all this confusion since 2019 with the original Secure Act, what we're working under now, and the change to the required minimum distributions for inherited beneficiaries. So just as a reminder, and Andy's going to touch on this in the letter, but what happened is we assumed one thing for the last 2+ years, and then the IRS came out and said, no, this is what we want. And what they want is if someone has already, the person who passed away has already began taking required minimum distributions, then the person inheriting that IRA not only has to deplete that IRA by the end of the 10 years, but they also must take required minimum distributions along the way. Now, if the person who passed away did not yet start their required minimum distributions, then there is no requirement during that 10-year period. It still has to be, the IRA has to be depleted within that 10-year period, but there's no requirement before that. So it's terribly confusing. I got to tell you, I think it's just more and more challenging as this legislation rolls out. It just gets more and more confusing. So you can see here, it reads, the new Secure Act regulation released in late February created a firestorm of confusion and complexity. We've addressed concerns in recent Slott report articles that will continue to do so, and will continue to do so as issues arise. However, as of now, one question has emerged as the most popular. How do beneficiaries handle missed 2021 RMDs within the 10-year payout rule? A lot of people didn't take them because they didn't think that they had to take the required minimum distributions. In fact, that was the belief of the overwhelming belief of the industry. And the IRS came out and with an opinion and clarified that, because at first they came out and said, no, you must take required minimum distributions during that period. And then a few months later, they reversed that and they clarified it. Now they've come out in this regulation and they've said, no, we're changing it again. You have to take these distributions. So people are saying, well, wait a minute, what about last year? We didn't take one last year. Are we going to have to pay a 50% penalty for that? So Ian touched on this. Andy says in on March 7th, yet the question persists. Here's some background. This is a repeat of what I just told you, but eligible designated beneficiaries are permitted to stretch inherited IRA payments over their own life expectancy. As such, required minimum distributions must be taken from the account annually. Eligible designated beneficiaries include surviving spouses, children of the IRA owner who are under age 21, disabled or chronically ill individuals, and anyone not more than 10 years younger than the IRA owner. So that's the bit about eligible designated beneficiaries is a little bit more information than what I had told you previously. This is what I was talking about, but many beneficiaries do not qualify to be eligible designated beneficiaries. Most other beneficiaries use the 10-year payout rule. So let me get up here so you can read that. Under the 10-year payout rule, the entire inherited account must be emptied by the end of the 10th year after the year of death. For the past 2+ years, industry experts, this is what I was talking about, believe there were no annual RMD within the 10-year window. Nevertheless, the new regulation tells us otherwise. If the original IRA owner died on or before his required beginning date, that's when they must take RMDs. Then any subsequent 10-year period for a beneficiary or successor beneficiary will require RMDs within the 10-year window. He goes on to write, this leads us to become the question du jour. And since there's a 50% penalty, I just said this, for missed RMDs, it is understandable why this inquiry is so prevalent. If a beneficiary inherited in 2020 and was subject to the 10-year rule, do we have a missed 2021 RMD? The answer is nobody knows. Until the IRS provides clear guidance, what is the best way forward? Our advice is to sit tight for a couple of reasons. First, no one knew there were RMDs within the 10-year period, so the IRS could conceivably waive the 2021 RMD on inherited IRAs. Or the IRS could say the 2021 RMD must be taken, and they will issue a blanket penalty waiver. Hopefully, the IRS won't make everyone take their 2021 RMD and then also apply for an individual penalty waiver. Yeah, that would be a mess. Second, regardless of when a person takes the 2021 RMD this year, there are no accruing daily penalties. Whether it is taken today or in December is irrelevant from a penalty perspective. If it turns out the 2021 RMD is required, withdrawing it early versus later this year will have the same result. Except for the fact that if the markets continue to be down for the year, of course, you're going to have a greater effect on your overall investments using, waiting till later to withdraw that required minimum distribution. So we suggest patience for now in the hopes that the IRS will give us some guidance on how to handle missed 2021 inherited IRA RMDs within a 10-year period. And folks, this is a complete mess. I am just so disappointed in our government agencies sometimes, not just with their lack of customer service and just making things more complex than they need to be. And it doesn't get easier. There's nothing about new legislation, this new Secure Act, that is going to make things easier. So here's our mailbag. These are simple this week. So the questions are about once per year rollover rule and income for Roth IRA contributions. And this is the Slott report mailbag. So of course the mailbag is when people write in and they have specific questions. And these are being answered by Ian Berger. So today's question you can see here, let me frame this so you can read it. There you go. So highs way up here. Again, you're looking at my notes. I'm not going to format these. I don't mean to make it difficult for you, but I think you can read them along with that. I have a client that needs funds for a short period of time, so he plans to use a 60-day rollover. I'm down here. 60-day rollover rule to borrow money from his IRA and return it within 60 days. This is almost always a bad idea, folks, and it's so tricky, and it can easily trigger tax. And this is a really good example of misinformation that people read on Google, hear from friends. I have certain clients who are always listening to different things, and they come back with ideas, and they're disjointed often about they might hear one thing over here and they piece it together over here, and these are intelligent people. I'm not saying that they're not intelligent, but you've got to be very, very careful. That's one of the dangers about all this information out there. So in this case, he has a traditional IRA and a Roth IRA. He's under the impression that he can do a 60-day rollover for each account. My understanding is that he can only do one 60-day rollover regardless of account type during any 365-day period. So he can only take funds from his IRA or Roth, but not both. Am I correct? The answer is yes, you are correct. Traditional IRA to a traditional IRA rollovers and Roth IRA to Roth IRA rollovers are aggregated for the purposes of the 1-year rule, once per year rollover rule. So that could be really devastating for someone who, if your Roth rollover got completed first, and then your traditional IRA was subject to tax and you weren't planning on that being subject to tax, or if your traditional IRA rollover, 60-day rollover got completed, and then you could not replace your Roth funds. Think about all those years that you've worked to set aside money in Roth IRA, and then just because of trying to do some cute scheme, you take $50,000 out and you can't get it back in there. Even if you don't have to necessarily pay tax on that, if you've met all the requirements that you don't have to pay tax on any piece of that, boy, that would be a real shame. So be careful. So here's the next question. Hello, Ed and Ed Slott team. Do dollars that hit the 1040 from a Roth conversion get discounted when calculating modified adjusted gross income for a Roth contribution? Have a great day. This is really important. This is something that I have this conversation with accountants each and every year. An accountant will call me and say, well, you know, you did $100,000 Roth conversion, so now my client can't do, they're over the income limit for a Roth IRA contribution. So what this writer is asking is, does it count? Is that actually the way it works? Does it hit that 1040? They're saying, does it fall in that graduated cylinder for taxable income using your modified adjusted gross income when calculating what that income is for the Roth contribution? So the answer is yes, they get discounted. So their modified adjusted gross income is used to determine eligibility for Roth IRA contributions. Modified adjusted gross income is a person's federal adjusted gross income with certain adjustments. One of those adjustments is a subtraction, and this is a little vague the way he writes this, but it's okay. One of those adjustments is a subtraction of income generated by a Roth conversion. So basically, even though that $100,000 conversion will be counted for as your modified adjusted gross income for your tax purposes, it is not going to be counted for your modified adjusted gross income for Roth contribution purposes. It's removed for that. For a full list of adjustments, see modified adjusted gross income for Roth IRA purposes and IRS publication 59 or 590-A. So that is it for, I hope that was helpful sharing my screen. Give me some feedback if you think it was or was not. And I'm moving on to investments. And you know, I'm actually going to share this screen too, because I'm going to talk about what you may be hearing, which is an inverted yield curve. So this is I get this market reviews at a glance every week from this company, Invesco. You can see their information up here. And I often refer to this section here. These are the global markets, the fixed income. These are bonds here. And then generally interest rates here. There's a lot of other information in here. And we're going to talk about the yield curves up here in this corner in a moment. That's why I'm sharing it with you. But you can see here that these are the weekly returns, year-to-date returns, and then 1 year. So 1 year represents April 1st last year, 2021, or April 1st, 2022. So we call those year over year or 1 year returns. So you can see the markets generally were flat or down. This is the Dow Jones Industrial Average. It was down just under, it was 0.12%. Still down for the year, 3.72. The S&P 500 was up slightly. The NASDAQ was up slightly. The MSCI World ex-US, so that means the total globe, less not including the United States, that was up slightly. EM is emerging markets. So you can see that that was up just about 2%, but still everything's down for the year. Most of these are still positive year over year. So, 1 year numbers, except for, of course, emerging markets and small companies. What's really triggering a lot of people is this section here with bonds, where my safe money is. Am I not sharing? Wait a second. I see some questions. Oh, thank you. So Don and Jane says sharing screen was great. That's great. Thank you. Appreciate that feedback. So most people, this is really concerning them. This is my safe money, put money into bonds. So you'll see that the Barclays aggregate bond index, that's what that is down for the year, 6.19%. Most people weren't expecting that. No matter how many times we told them in the last years, we're concerned about interest rates. You've been hearing me say, The bond markets are really what keep me up at night, because that should be the safe haven for stocks. But when we have this collision of pressures on the stock market, rising interest rates, hyperinflation, or just high inflation. I hadn't anticipated 7.9% inflation. I just anticipated 4 or 5% inflation at the worst. But these are going to really push up those bond prices or bond yields, and cause those prices to drop. So you'll see here that if your stock portfolio is down 3% or 4%, your bonds are down 6%, you're really feeling it on both sides. That's why, folks, that's why we do principal protection. That's why we do the account segmentation. So we have a bunch of cash sitting on the side for you, so you can do what you need to do if you're in your retirement. Principal protection certainly, helps tremendously, because you can't go below zero. But you're hearing right now about this inverted yield curve. So let me pull you up to this top right-hand side. And this gives a bit of an illustration. So I thought it would be good to share. So you'll see here, what this shows you is the different colors are different times. So this is 4/1/2021, 3/1/2022. So that's dark blue, and that's a normal yield curve, right? So what does yield mean? It means dividends, interest rates, the general return you get from bonds. We're talking about bonds here, US Treasuries. So 3-month bonds, 6 months bonds, 2-year bonds, that's when they mature. So bonds that mature 3 months from now, we expect them to get smaller interest, because you're not tying up your money for that long, right? So you don't get that much interest for that period of time. 6 months, you get a little bit more. 2 years, well, you get a little bit more. You see, it's barely moving. A normal yield curve would it would just progress like that. 5-year, increases, but this was still below 1%. You'll see 1, 2, 3%. That's what that represents over here. And then we get here, this was, again, looking at this 4/1 line, 2021, so a year ago. We get here just under 2% in the 10-year Treasury, and the 30-year Treasury, was, we're looking at just over 2% here. And then March 1st, this is what the yield curve looked like. It was starting to increase here, and then it had this flattening they were starting to talk about. Well, here's this inversion they're talking about. See where, and it's really triggering back and forth, and it's a real concern, because an inverted yield curve is a precursor to recession, right? It's kind of a sign that a recession is coming. So that's why everyone's talking about this. So you'll see that the numbers are slightly higher here in the 2-year over the 30-year. Well, who would buy a 30-year bond if you're getting more yield for just holding it for 2 years? That's the problem. So when you hear about that inverting yield curve, this is the opposite of what we want here. So pay attention to that. I hope that helps, and I hope that makes sense. Let me bring this back in. Okay, looks like we have another question. Stand by. Let me come back to these. All right, Larry, I don't know if I can make my cursor larger, but thank you for that. I'll see if I can maybe, let's see, I have this spotlight. I don't know if that's better. Maybe I can do that when I'm sharing. That probably makes more sense. My problem here is I don't always know how to turn that off. So I think that might help. So you can kind of see the red dot as that goes along. Okay. And then I'll go ahead and answer this question. So Michael asked, on an inherited non-spouse Roth IRA, my understanding on the Secure Act that the funds can grow tax-free for 10 years, no withdrawals required, then the funds had to be withdrawn, right? It depends. So Michael, that's what we were talking about. So if the person who you inherit the funds from had a required beginning date that's already passed, so they had to take their required minimum distribution, then you're going to have to take required minimum distributions during that 10 years, and then it still needs to be depleted at the end of that 10 years. If that person did not take, and you're not an eligible designated beneficiary, if that person has not had to yet take required minimum distributions, has not triggered the required beginning date, then you do not have to take distributions under the current rule during your lifetime or during that 10 years, but you have to deplete it by the end of 10 years. So I hope that makes sense. Thanks, everybody. So let me clear these. All right. Okay, let me stop my share and move on into my notes here. All right, the last comment I'll make about investments before I move on to the financial planning topic is just a little snippet from Robert D. Lucia from Prudential. So he's talking about this effect of what I was sharing with you. Stock markets are down, bond markets are down, and how the individual investors are finding that. So he writes, the global financial markets suffered widespread losses in the first quarter, accompanied by heightened volatility. We all saw a lot of swings the first 3 months of the year. The sharp increase in market volatility can be attributed to rising uncertainty pertaining to the Russian invasion of Ukraine and the outlooks for energy and commodity prices, inflation, and monetary policy. A lot of uncertainty. We don't know what things are going to cost. We don't know where this is going with inflation. And we really don't know what the government's going to do about it. And we don't know the effect that it's going to have. A lot of people believe that the Fed is very, very limited in what they're going to be able to do to stave off this high inflation. And I'm one of those folks, because you can't raise rates too aggressively. And we need some aggressive measures during this time. Traditional balanced portfolios experienced one of the worst quarters in decades as measured by the S&P 500. The equity market, so that's stocks, equities or stocks, lost 5%, while the NASDAQ, again, stocks, fell by 10%. U.S. investment grade bonds lost 9%. So bond allocations lost 9%, while an index of long maturity U.S. treasuries, that's the 20-year plus, fell by 13%. Wow, they're really big numbers on the bond side. And that's what I'm reading has investors most concerned. I'm not hearing it from our individual investors, thankfully, but that's what I'm reading out there, has your average investors concerned. So sorry, I got a question that took my attention. So let me, I'm going to jump to the Secure Act 2.0 for financial planning. And let me see, I do have a question here. So Laxman said, confusing part is your tables show a negative year-to-date return for both equity and bond yields, whereas the yield curves show positive growth. So good point. There's a difference between rising interest rates and bond prices, and it typically is inverse. So while your bond, especially if you own your bonds and mutual funds, like the vast majority, or ETFs, exchange traded funds, like the vast majority of people do, as interest rates go up. So let's just say you buy a bond that has an interest rate of 1%. And then 2 months later, you can buy that same bond from that same issuer, from that same maturity, and your yield, your interest that you're getting is 2%. Well, the one that you bought that is yielding just 1% is now worth less, right? Like if you bought that bond for $1,000, there's no way you could sell that bond on the open market for $1,000. It would have to be discounted to match the decrease in yield, right? So because now you can get the same bond, same issuer, same maturity for and make 2% on that money instead of 1%. So that may only be worth now $800. Well, that's a 20% drop, right? So that's what we're seeing out there, Laxman. I hope that makes sense. Let me clear this. Okay. All right, I'm going to share my whiteboard here in a moment as soon as I find it. And this is a new whiteboard as of today. They changed their whiteboard today for me anyway. Looks like another, thanks, got it. All right, good. Glad that was a good explanation. All right. Here we go. Okay, so here's our financial planning topic for today's Secure Act 2.0. So the Secure Act, they're calling it the Secure Act 2.0. So the original Secure Act passed at the end of 2019, a lot of changes. Now there's a lot of proposed changes in this one. So let me see if I can use my spotlight without blowing anything up, Larry. So that passed the House of Representatives last week. I think it was last week, maybe the week before. I lost last week altogether, 414-5. So overwhelmingly supported. It's reported to be overwhelmingly supported in the Senate. So it's likely that this is going to become law. This increase RMD ages. This is a good thing, right? So one of the big things, let's see if where's my pen? I don't learn things all over again with this. All right. So increases RMD age. Age 70 increases to age 73 in January 2023. But now look at this. So this is good, right? So that gives us some time to plan. But we don't see another increase here until 2030. So not until 2030 do we see it go to age 74, and not until 2033. So we've got 11 years here until we get to age 75. Boy, it would have been nice to see this much, much faster. I would have preferred. So 2023 is fine. Give me 2024. Give me 2025 here. And by 2025, we're at age 75. That would be beneficial to the people out there. This is so uncertain. This will probably change. Well, I don't like this pen color. It's weird. But it'll likely change. And between now and 2030, that it's almost this uncertainty that is just completely unnecessary. So that makes planning very, very difficult, as you can imagine. But where we're standing right now is age 73. It is heading in the right direction. Listen, if I had my druthers, if I was casting a vote, I'd want to make it age 75 starting tomorrow. Let me see if I can change this crazy color. Just give me green. Green's good. There we go. Okay. All right. So that's increase in RMD age. That's what's proposed in the new legislation. This will likely not change. I think this will go through. I think all these things will go through, but this is unnecessary craziness. And it's all about driving tax revenue, right? Because actuaries have done the work for the legislature and said that if we delay RMDs now until age 75, we're not going to get enough money to reach to do what we need to do in our budget. And they already don't have enough money. So it would just make things worse. It's set up to reduce the penalty. But in my opinion, this is my commentary, make it more likely to have a penalty on RMDs. So I didn't write that on there, RMDs. So right now, if you miss your RMD, you're subject to this 50% penalty. So what happens if you do that? Most people file Form 5329, and they have some good excuse for missing this RMD, and the vast majority of the time, that's there's a waiver on that penalty given. This is going to be reduced to 25% and then further reduced to 10% if it's corrected quickly. So one of the things that people have to do when they file that Form 5329 is you also have to take your required minimum distribution. So I think what's going to happen is that while the 50% is eliminated, we're going to see many, many more of the 10% penalties out there. So it's actually going to be a revenue generator for the IRS. So it's good that it's reduced, but you're going to see much more, the actual penalties are going to be much more likely, just at a much more reduced rate. So there's an auto enrollment for retirement accounts. So 3% of salary, the employee, its employee can opt out. So for a 401k plan, 403b plan, there's an auto enrollment, and then the employer can contribute 3% of the salary, or excuse me, employer would contribute 3% of your salary. And then that does increase over time. You can still do your own increases, or it doesn't limit you to 3%. It's an automatic enrollment of 3%. I hope that makes sense. Catch-up contributions, this is another one. Why wait? They're increasing catch-up contributions, but you have to wait until currently now. If you're over age 50, you can contribute more into your 401ks, retirement plans, or your IRAs. Well, now they're saying we're going to add on to that. It's not replacing, it's adding on to that. At age 62, 63, and 64, you can contribute up to $10,000 more. Well, again, my commentary would be, why wait? Make that age 50. Right? I'm 53. Yeah, that's right. Let me put in, $10,000 additional. I would love that. So, a little, that's good, but it could be better. They want to create a national lost and found for 401k accounts. This is good in theory because people are often forgetting about typically smaller 401ks and retirement plans that are out there. I'm just always concerned that when the US government is handling something, that it's not going to be very efficient, but at least there'll be one kind of place that you could go to find your 401k or lost retirement plan. QCD enhancements. So QCDs are great, qualified charitable distributions. Currently, an individual who's over 70 and a half, again, another more IRA confusion, not 72 under current RMD rules, but it's still stuck on 70 and a half prior to the Secure Act. But that's a good thing. You can take per individual $100,000 and direct an RMD right to a qualified charity. Can't come out to you directly, but you can, if you're charitably inclined, you can take up to $100,000 of your required minimum distribution and send it right to a charity. So what's going to happen with QCDs? I had to write it down here. They're going to be now adjusted for inflation. That'll be good. So it doesn't have to be voted on over and over again. It can just adjust for inflation. And then there's going to be a one-time $50,000 QCD transfer that's allowable to a charitable gift annuity, which is not allowable now, or a charitable remainder trust. Again, not allowable now. Okay, and then more Roth contributions. So more Roth contributions, catch-up contributions will be the catch-up contributions I talked about above will be required to go to Roth. That's great. That may be a bit of a shift for people, but everybody on this webinar and everybody who attends our classes, reads the books we do, you already are Roth inclined, so that's good for you. So all those, up to $10,000 of those catch-up contributions must go to Roth. IRS, the IRS and the federal government, they want their money now, right? So that's good. That means they're embracing the Roth too. That's really good to see, and this should give you comfort. So, there's a lot of Roth in here. So they're saying you can, after age, what was it, 62, you can start making additional contributions, but they must go to Roth. So when people say, well, geez, they're going to figure out a way to get rid of these Roth IRAs, they want the exact opposite, because the Roth IRAs and Roth retirement plans, 401ks, 403bs, generate revenue for the government now. They don't have to wait like they do with traditional IRAs. They'd be better off because they're going to get more money if they wait, right? But they don't think that way. They want the money now. Matching contributions can go to Roth. This is a big deal. So currently, if your employer matches, so for our company, we match 6% of the compensation for up to 6% of the compensation, employee compensation, into their 401k. But currently, it must go into the tax deferred bucket. That's what the rules say. Now they're saying matching contributions can go to the Roth. That's great, because I want my 6% and you should want your 6% going to the tax-free bucket, right? Not the tax-deferred bucket, not into there. So that's good. And then some of the other items we have is a small business tax credits. There's some additional small business tax credits. There's this gift cards and other incentives. So right now, the only incentive that that an employer can give their employees to join their retirement plan is matching funds, right? Like the 6%, 3%, whatever your company does for your retirement plans. Now they're saying that up to a certain limits, they'll be de minimis, right? Small. There can be gift cards and other incentives to help save for retirement. Whatever gets you there. That seems silly to me, but whatever gets you there. This is important. There, for victims of domestic violence, there's an allowance to access retirement funds that aren't normally available for access without any penalty. So that's a nice provision of that in there. So there are the updates for the Secure Act. A lot of information in this legislation. There are other, I say they are the updates. There's other things. These are the things that stood out to me and that I thought would affect you folks the most. But there will certainly become more to come from that. And we'll talk more about it. So hopefully we condense this and we can just, this section here about required minimum distributions and make that a little simpler and just get to 75 as soon as possible. So that would be my goal. I'll lobby my congressman for that, or senator, I guess, at this point, and see if we have any impact. But that's it for today, folks. Thanks for all your feedback. Always good to see you. Look out for, let me stop my share. Look out for your invitation to David McKnight coming up, and I'll see you next week. Have a great week. Take care.